Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Monday, January 9th, 4:43 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market in a correction with a short-term uptrend as we had a follow-through day on Friday on the NASDAQ, and things were looking pretty nice with the gap up open and continue to run higher, but got derailed late morning and early afternoon as Fed speakers flapping their gums with hawkish statements led to some profit taking and a negative reversal. We'll get into all of it here shortly. Let's go to the trend gauge over here. Leaders still holding up okay, neutral with a green sub arrow. Short term, trying to make progress above this 21-day, excuse me, exponential moving average. We got above it today on the NASDAQ 100, which would have been a change in character, but we gave it up by the end of the day, just barely. Medium term, mixed bag versus the 50-day moving average. Long term, downtrend. All major indexes, with the exception of the Dow, below their long term declining slope 200-day moving average. So, what happened today? Coming in overnight, really healthy all overnight, opening near highs of the session at the morning, and nice gap up and a gap and go. We had a little bit of 10-point pullback and then just buying all the way up to late morning when we started to go sideways for a while, basing, but that sideways action corresponded with 39.50, which is the 40-week moving average on a weekly chart, and couldn't get any further than that. So we didn't make it up to the 200-day on the daily, but we made it up to the 40-week on the weekly, and 39.50 is a prior support resistance level. That was as high as we could go. Negative reversal there in the afternoon, and really just as strong the trend was in the morning, following up to a strong trend Friday afternoon. That trend was just as weak to the downside, just ticking, bleeding lower and lower. We gave up the 50-day moving average on the S&P 500, which also served as resistance on Friday, where we reversed. So an above and fail set up there. Key levels going into tomorrow, 3,900, and overnight 3,900 on the futures, 3,880 on the S&P is what we'll be watching. So the final numbers on the day, it was a mixed bag. Growth outperformed. G6 up 1.02%. S&P up over 1.2% at one time, gave it all up, down 0.08. NASDAQ 100 led by Tesla up 6%. Up 0.65%, but well off its highs, was up over 2% at one point. Dow up 0.34%. Medical stocks very weak today. That's the biggest component, medical healthcare. That's the biggest component of the Dow, so the Dow lagged today. I have an up arrow, but it's in red, so hopefully you know that means down 0.34%. Mid caps about flat. Russell up 0.17. Global diversified 60/40 up 0.15%. In-house GROTECTION down 0.30%. We'll go through everything that we did today when we get to the tail of the tape and look at charts of interest. Let's get into it here. Start off with what we do here at Revere: trend following. When the markets are healthy, meaning they're trending above their short-term green line 21-day moving average, medium term 50-day moving average, that's the red line, and the black line, the long-term 200-day moving average. We're as aggressively long in the market as the situation calls for. If we start to roll over like we did a year ago this time, first week in January, the clouds started showing up. The stops will take us out of the market. If the slopes of the moving averages roll over, we'll get more and more defensive. We break below this black line, we're really aware that the market at that point is flashing some unhealthy signals, and we will get to a maximum defensive posture to protect our clients from these losses that happen in bear markets. All bear markets occur beneath the 200-day moving average. So follow that one simple rule. You get defensive when you're under the 200-day moving average. You can save yourself a lot of financial, medical, emotional capital. and that's what we do here at Revere, protect the downside. That's our number one job. When the markets recover and get to a healthy posture, the returns take care of themselves as we re-engage in the market. And that's what we were looking at Friday with the follow-through day and today with the gap up and go. But you can see here on a 5-minute chart of the S&P, here's your here's your nice move up. So we had the jobs report and then some ISM data on Friday. Gap up, tested 3,800, and then 10 o'clock, good ISM data came out, trended higher, went sideways, broke above that 3880. That's why this 3880 level is what we want to watch for. This is where that little pause was Friday before we broke higher up to 3906. That's where the 50-day moving average was on Friday. We faded into that, gapped up above it today, pulled back a little bit, tested the 50-day and bounced, made a higher high. All good so far. Everything that the bulls could hope and dream for was working out. Nice trend up higher, a little sideways action here for about 30 minutes. Then we broke above 39.34, ran up to 39.51, but looky here, S&P 500, the black line there, 39.52 is the 200-day moving average. That's also 39.50 is a big support resistance level, really going back months into last year. We battled around it a couple of weeks ago and just couldn't get any further up above that. We reversed back to the 5-minute chart here, and then it was just selling down on the 5-minute chart, just showing going lower and lower. Little bear flag here at 39.10 as we tested the 50-day. Looked like it was going to hold, but no, the last hour or so, just straight down into the close. So we've got good news and we've got bad news. The good news is we had a follow through day. We had a nice run up here from 3,900 to about from 3,800 to 3,950. Okay, so that's 150 points. You can give back half of that and the rally still be intact. So that would take us back to 38.75, which is right around this 38.80 level, which is where we put this little intraday cup and handle in on Friday. That's why I'm saying that this is such a key level. So basically 38.75, 38.80. We need to hold there overnight, and tomorrow maybe we lose it, but if we do, we recover it quickly. That would be like a little false breakdown. And then the next level that we need to look up for is recapturing that 50-day moving average that we gapped above today, and that is at 39.06. So on the downside, really tight ranges here are key: 38.80 to the downside, 39.06 to the upside on the 50-day moving average before we and then, of course, 39.50, the high today, and then above that will be at 39.90, 39.90 on the 200-day moving average when we open and start trading tomorrow. So a lot of levels in here, both to the upside and to the downside. For now, this breakout from that 3-week trend is still holding the high. Let's go to the 60-minute chart. It's more evident here. Here's the break above there, that 38.90 level, and that's right where we're at. So recall a couple of weeks before this 38.78-ish, and that was 38.80. Friday also we had this 38.90 level. That was the prior high. We pulled back, and that's where we stopped going down today. Today's low was right at 38.90. Look left to be right. Those levels, the market has a memory and it pays attention to it. And bulls and bears battle at those levels accordingly, and then you see who wins, and that see if that trend sticks or if it just continues to be bear market chop. That's why bear markets are toughest on bulls and bears. You get these strong rallies that suck all the bulls in. You get these negative reversals like we had today. We got caught in that a little bit. We'll talk about that momentarily. And that's why you keep your positions tighter, and you're aware of all of the levels, both on your stocks and the indexes, because stocks will follow 75% of them will follow the overall action of the indexes. So there we are on the S&P 500. Bad news on the Nasdaq 100 here was that we got above the 21-day moving average and then negative reversal and could not quite hold it. Only a tenth of a percent below the 21. So arguably plus or minus a tenth of a percent. It matters when the bell rings, frankly. But let's go to the 60-minute chart here, and you can see uh, this resistance we didn't clear the resistance levels from the 20th and 21st of December on the Nasdaq the way we did on the S&P. In fact, that's right where we ran into resistance today, which is close to the 50-day moving average there. The high of the day just barely below that 50-day moving average, which is declining still on the Nasdaq 100, unlike the other indexes where it's trending higher. So there's your failure on the Nasdaq 100. We know how weak that has been lately. Going sideways on a relative basis over the last week and a half. So we got to see what comes in uh, tomorrow. Let's go to the Dow, which lagged today due to the healthcare overhang. There's a big JP Morgan healthcare conference going on right now. There's also some retail conferences, and you're seeing a lot of moves in both directions, both in medical and retail stocks before the market today and intramarket as they um, present at these conferences, and then the news gets sent back to the mothership, and the appropriate action is taken. For example, Lulu said their margins were going to be tough in the fourth quarter. Lulu down 9.9% today. Macy's warned after hours on Friday, down 7.7% today. On the other hand, Five discount retailer gave good news. It was up 5.5% today. Novacure, which was a big gap up on Thursday, inside day on Friday, down 16%, basically giving back most of that move. Very big mixed bag on biotechs here. I've got some that were up double digits too. Uh, we'll talk about them later in the week if they continue their moves. So that's a little bit about what's going on in the retail sector and in the medical and biotech sector. So back to the indexes. Let's go to the Dow here. Strongest sector, flagging on relative strength over the last week and a half, however. But relative to its moving averages, it's the strongest sector. Also a negative reversal here below the 34,000 level. Need to hold the 50 and the 21 there, which are around 33,300. Mid caps, MDY, made a higher high, but also reversed, just barely negative today above its uptrending. That key 448 to 450 area where all the moving averages were stacked up. The 50-day moving average is poking its head above that level now. See if that'll act as resistance. That's right at 450 on any pullback. And finally, small caps. As I said, small cap growth outperformed today. But small caps ran into the 50-day moving average and reversed there also. Finished slightly positive above the 20, so above the 21, below the 50. That's kind of a common theme across the board. How did the equal weight indexes do? RSP barely positive on the day, so slightly outperforming the market cap weighted S&P 500 and QQEW. Down or up 0.34%, under perform the QQQ as some of those big NASDAQ 100 heavyweights had good days today. Let's go to the VIX. Even though the market was positive, the VIX was negative, was positive most of the day today also, which is inverse of what you would expect, but an inside day into the declining 21-day moving average on the VIX. Dollar, weak all day. Look at a 5-minute chart on it here, making new lows, gap down, and then sideways most of the rest of the day after late morning. But you can see on the daily chart here, still trending, just a one-day wonder above that 21-day moving average. That was an aberration, then a big reversal on Friday with the employment, or not with the employment number, with the yeah, it was the jobs report and then ISM data that came out, big negative reversal and a follow through to the downside on the dollar here. This is why international and emerging markets are outperforming our domestic markets lately. Broad bond index BND, positive on the day, up 0.27%. TLT, this is the big cap, up 0.53%. So that means that we're going to see rates taking a tick down. Here's TYX, closed at the bottom of the range of the day, also down 1.14%, following up to the downside on Friday's news. So a little bit of a negative divergence here with rates being lower, but stocks being lower also. They have tended to move in the opposite direction. And then the positive news that came out on Friday, the take on the market was that there's no way the Fed can keep raising. But then we had these hawkish Fed speakers today, and they reversed rates intraday. And here's the TNX also down on the day. But if you look at the 5 minute, you can see how they actually gapped up before going lower, and then the Fed started jawboning here, and you know the rest of the story, finishing at the lows of the day on rates. How did gold and gold stocks do? Dollar down, gold up, making a higher high, but at the bottom of its range on the day. Silver still underperforming, still stuck in this range that gold broke out of, down 0.82% on the day. GDX, gold and silver stocks, were pretty volatile intraday today. Started out positive, down, up, ended up closing near the lows of the day, down about 1%. So those are the big indexes. Let's get to the tail of the tape now. Um, Headwinds pretty much still the same on a macro perspective, although the dollar in flux here now. Strong for so long now, it's been weak for a couple of months. Inflation, is that still going to be, should that be moved to the uh, neutral column? Probably. Recession, rising interest rates. Well, interest rates aren't rising anymore uh, as of late. So a lot of changes going on, and they're all in reaction to this. Are we going to be in a recession in 2023? Economists think so. Some Fed speakers don't think so. Some smart people don't think so. Some other smart people are saying it's going to be worse than we can even imagine. All we can do is watch price and volume, understand that it's going to be choppy because of the cross currents, and see how the markets react to the earnings that start coming out later this week for the first quarter. Sentiment, fear and greed ticked up to a 48. Uh, Kind of mixed here between our bull and our bear case, still under the 200-day moving average, but we did have that follow through day. But today, the day two was not what you wanted to see after a follow through day. I talked about the Fed jawboning, Bostic, hawkish, Fed daily. We're going to be above 5% until the job is truly done. She really talked tough today. Uh, Day counts up one with a negative reversal. Second day above the 8 and the 21 EMA on the S&P. Powell speaks tomorrow before the market opens at 9 a.m. So that should be very interesting to see the reaction there. Expectations positive today after the 1-6 follow through day, followed through in the morning, but derailed late morning and early afternoon by the Fed speakers. Maybe just too far, too fast to. Also, as I said, we haven't given back half of the move yet. We can give back half and it still be considered okay from a trend perspective. Above and fail at resistance, this 3,900 level on the S&P. Above and fail at this 21-day moving average, 270.87 on the Nasdaq. Here you can see the levels on the day. Broke out, went up to 39.51, and then just trended lower on the day into the close. There are the various ranges. We broke both above and below the open 30-minute. That gives you a hint that the market can't decide who's in charge. And that's pretty much was clear from the action today. Strong sectors, solar, semiconductors, and software after really getting beaten down last week. So a bounce on those. Oil services, uranium. And then here's the flip. We started out the day with bond yields higher, but by the end of the day, they were lower, that little gap up that I showed you. So flip that for bond prices, started out lower, ended up higher across the board. Dollar down, healthcare and biotech down, retail down, and ITA down. Here's our focus list. We'll look about those momentarily. So here are our intraday trades. Let's talk about these. S&P 500, SDS was the inverse ETF. We held on to that. We started getting long when we got above the 21-day moving average on the S&P on Friday. That level was about 38.70, right? So when we cleared this little cup and handle is when we started putting on the U Pro. And we added to U Pro today when we moved above this area and started pulling back at 39.50. We looked to the stochastics and started adding into it with the expectation that this pullback would hold at 39.20, but it didn't hold. We went lower. And also when we broke above here in the morning, so it was a two-step process, adding to UPRO here on the flag as we were oversold and started to pull back, and then getting out of SDS when we broke above this little resistance area here. So this is where we took off our inverse ETF. This is where we put on a little bit of UPRO. So we took about about a 6% loss on a 5% position on the SDS. And SDS, we added some on Friday, and then we added some here. Net, we're down a tiny bit on UPRO. So got rid of SDS. Let's see what else we have here on uh, BA. So why'd we sell BA? It's one of the strongest stocks in the market. Well, I noticed Friday that we were over 4 ATR above the 21-day moving average. That's 11.4% near the close. Boeing has a 2.7%, 2.7 to 2.8% ATR. 4 ATR above the 21 is a lot. You're guaranteed that you're going to pull back. When the market was up this morning and Boeing wasn't, we decided to see how it played out, knowing that it should pull back. When it pulled back and got pulled back to the +2 ATR, +2R gain, that's when we exited. So we exited strength on weakness, pulling back. That was the same time when the market started rolling over. So book the profit. We'll look to get back into this as it pulls back to either the preferably the 21-day moving average or this 200 level. We will be looking to re-enter Boeing. So we booked the profit on that. The other trades we're adding to ELF and SPXU. I talked about, and actually it's UPRO, not SPXU, that we ended up buying here. It was UPRO. Now, ELF. I talked about how a bunch of retail was weak early in the morning, most of them, not all of them. ELF gap down here, and then it started rallying. And when it started rallying and got back above this little shelf area here intraday, the bottom of it in here, we added to our position. Good. I mean, it didn't turn out obviously the way we wanted to as the market rolled over, but it was a good risk reward area to add to our position. This is a leading stock. It was pulling back volumes above average today, but all retail volume was above average today. This is not what you want to see on the action of this today. Okay, very clear here that 57 is the breakout area. We closed at 55 and change. The 21-day exponential moving average, if we get stopped out, it's still within our risk tolerance of the 0.2% versus the overall portfolio. That would be below 55 in ELF. A little disappointing action in this today. They don't all go the way you want them to. That's why we employ risk control. So ELF, we own 3% size in ELF now. Let's talk about something good that actually happened. AEHR, we took that position around the 50-day moving average, up 16% today on 182% average volume. The earnings report, when you see a day two higher high like that, and after earnings, you got to pay attention to it because it means, plus over the weekend, it means that companies had a chance to go through the earnings report, decide if they wanted, if they didn't get involved, whether or not they want to. And even with the negative reversal, this thing held up like a champ today. So AEHR, with the fundamentals, they make money. Growing into 2023 and 2024, 54% earnings growth, 220% uh, earnings growth, 54% sales growth. They provide the um, test systems for silicon carbide clients, which is huge in EVs. They're in the right spot, and the stock is acting the way it acted before with this big move up, formed a base, another big move up. Harsh pullback here after some of their clients reported weak earnings, but we got rid of all the weak holders and the gap up. 518%, up 32%, gave people that might have gotten stopped out an opportunity to get back in. Note how buried the stochastic was, so it really did clear everybody out. So AEHR up 16%. Let's put that in the plus column for today for Revere Asset clients, offsetting some of the other uh, things that didn't go our way. So bottom line for the day, morning gap and go derailed at 39.50 resistance by hawkish Fed speakers. Haven't given back half of the gain yet. We'll see what tomorrow brings. We really need that 38.80 level to hold on the S&P. That's a 50% retracement. That's critical to several other areas that I talked about on shorter term charts. That's critical to this cup and handle here. It's critical on a 30-minute chart over here, 38.80, 39.90, where we held today. Not what bulls wanted to see, but all hope clearly not lost yet. So we'll get to some more focus charts here, some things that the fellows brought up and we discussed on our morning call, and then we'll wrap things up here. So you've got the support and resistance levels that are critical. Let's look at a couple more charts here. Four, I already talked about this. This was one of my focus ones on the day. Uh, Visa, MasterCard, and Four were all upgraded by Goldman Sachs pre-market, and this held its gains pretty well today. SMCI also gapped this morning, but gave it all back. This thing is a bucking bronco. And look at this on a 5-minute chart. Gap up, run, and then from 91 to 85. This has like almost an 8 to 10% ATR. Brutal. You can't put anything like this on in any size unless you've got nerves of steel and clients that uh, have nerves of steel, and we just don't. I'm just glad not to be involved with that after that negative reversal. TJX down 1.46% on the day, a breakout from last week. I've got a list of 40 breakouts. We'll go over tomorrow maybe to see how they're holding up. We're watching those charts closely. TJX looking good. Ross Stores also broke out. Let's see how they fared today. Negative reversal also, so that's a failed breakout on Rost. INMD, this was forming a nice flat base and had some good numbers, but negative reversal down 6.6% on heavy volume today in mode. And CPRX, another biotech, broke out on Friday, negative reversal today. But as I said, medical and biotech stocks were weak across the board today. I don't know if it's just they ran into that JP Morgan health conference and people are just taking profits on them. But the fact of the matter is that let's take a look at XLV, the key sectors related here. That's not good. Couldn't get above the 21. And let's take a look at the two big biotech sectors. This is the big cap one, IBB. Negative reversal, tried to break out above the 21 and failed. And XBI, this is more equal weighted and has a bunch of smaller ones in there, just continuing to be extremely tight, unable to make up its mind whether it wants to break up, excuse me, or break down. So that's where we stand on biotech, and that's going to wrap it. As always, love to hear your feedback. Email is don@revereasset.com. You're interested in becoming a client, email my partner, Dan Stewart, dan@revereasset.com. Or you can call us at 855 Real Wealth. That's 855 732 5932. Remember, it's not how much you make in the markets, it's how much of that you can keep. That's why we protect the downside primarily as our number one job, and the returns will take care of themselves. When the market returns to a positive nature, I know it's hard to be patient waiting for that, but it's coming. That's United States of America. What we're all about is freedom, ingenuity, and hard work, and presenting it's capitalism personified, U.S. As long as the golden goose of capitalism is still alive, we're always got our eye out for the next big winners. So that's going to wrap it. Ending up Monday, January 9th. This is Don Vandenbord. Just the facts, telling it like it is. Thanks for listening and have a great day.